Hey everyone, thank you so much for joining Archangel Alt. And we're excited to share with this next lesson plan. Now we're going over the principle of thirds. The last one that you should have seen would be the rule of fifths, and you've either seen the one introductory video or gotten into the advanced training on that inside of our paid subscription, only $99 reoccurring a month. And for that, that breaks down to roughly only $3 a day. You get all the extra advanced stuff, the advanced live trading with you, Q&A. We won't go into the whole list because we're going to get right into this incredibly important rule of thirds, principle of thirds. It's just really exciting because this is something that we've had to hold close to the chest, just like the rest of our system, because it really works. So, we've had to, sign non-disclosures and such, and now we're actually able to share it with you. So I feel privileged to share it in the same way that I'm hoping you will get something from it. So weird things, anomalies happen with every single coin, so it's really tough to find, just the absolute classic perfect example. Bitcoin, of course, is, oftentimes just all over the place as well, so it's not necessarily the one perfect example. I've been going through just looking at different ones as they go. This is actually not too terribly bad. So, gonna give it to you in a nutshell. And this is just a basic overview. What you should know, this is absolutely enough information to use the principles to trade on. And I'm going to think in terms of what I teach in advanced versus paid to make sure that I use the terminology that you're familiar with. So to begin with, this, it doesn't always appear in the same place, and it's not always, the same scenario from coin to coin. They all have their own personality. They all have their own unique shapes. That's why we're going to look at those together as we're trading live, okay? Sometimes it's not necessarily going to be about getting in and out of the trade. Sometimes it's going to be about knowing when not to get into a trade. But what we're not going to do is to just kind of, step around the logic and pretend like we're doing something better than we are. We're going to, assess things accurately. We're going to keep, all of our hodls just as clear as all of our trades, all of our clears, all of our profits. So as we go along, you're going to be visualizing the up and down movement of value on the market. So, you could completely ignore everything in the center and just look at, who's buying, who's selling, at what amount, and where do those numbers come together, and what does that do in relation to Bitcoin. And there are people that will trade just based on the order book. And I tell you, once I've known a coin's movement for a while, I can think just in terms of the numbers and not even look at the charts at a certain point, because I'm still thinking in terms of what that would look like on the charts. So I better slide this into the right position or I'm not going to be able to see what I'm doing. So hopefully I'm stretching this back to the right place. Forgive me in advance if I need to readjust that. So, here's our order book. Here's the trade history. Here's where we see our charts. And I've intentionally moved the volume and MACD and all that kind of stuff out of the way so you can just see a really big version of this, okay? So the principle of thirds, it starts by being able to look on your charts and decide what the movement is in order to decide when you're getting in a position. So the first thing that I'm choosing this just because it gives a really obvious example of one of the more simple aspects of what I'm calling the principle of thirds, is that things tend to happen in threes. Okay, I'm not trying to be superstitious, but there is a reason that things average down and then the average averages down, and that's because of the way that people assess their moves psychologically. You might say, well, isn't there a lot of bot activity or isn't there a lot of manipulation? And that's the thing, is that the bots are designed to, they're designed to respond to the way that humans put their trades in. So it's one of those, once again, self-fulfilling prophecies that always happen, no matter how much the electronics are doing it for us. Eventually it'll get to the point where bots are trading bots and trading bots and trading bots, and then we'll talk. But in the meantime, we can see that this came onto the market and it hit its first down, and then it went until it hit its second down, and then it went until it hit its third down, and that was its big up. Okay? And then as it's coming down, you can see it did this, it did this, I mean, yes, there is movement in here, but really, if you're looking at when did it stop going down, it didn't stop going down until here. So I kind of see boom, 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 boom. Interesting. So it made it back up, and then it started to come down, and it didn't come all the way down for some reason. It actually looks like if you divide it from there to there, you have the top third, the middle third, and the bottom third. Isn't that interesting? So as it went along, this doesn't guarantee that, oh, this is going to equal this and this is going to equal this. People will use the Fibonacci sequence to measure in which percentage or which number range things are about to scale to, and where is the bounce and where do people tend to respond to things. That's fine, but what I've found is that people that do that are still using too broad of a stroke. They're taking their focus off of the actual movement within the candles, and we have so much information inside the candles themselves that is just so much more valuable to understand the trend that these things happen in. So let's look at, I haven't actually looked at this as an example, and it's not, the principle of thirds is not a guarantee that everything happens that way, but it happens so much that it's worth helping you to mentally start from the big overview, bird's eye view, and then zoom in and zoom in and zoom in. And I don't know if you noticed, but when we were talking about the rule of fifths, I had 3 layers of, your dividing numbers from your budget down to see what your trade size is going to be. 1 level for your overall HODLs, 1 level for your constant circulation, and 1 level to establish the trade size. So we've come down here, we've looked at this. So now we have a new, this was the lowest point before it started going up again, right? So what I'm seeing here, hopefully I can get it to the right place. Okay, so I think that this is the one. Okay, so it made it up. Boom, boom, boom. Breaking it basically into 3 pieces, you have this almost perfect length of time here before it readjusted itself. This perfect length of time right here, and this right here. So it went up in 3 again, just like the first time. And then boom, boom, boom. Not exactly in the same places, but not completely far apart from each other. But if you look, where did it go back up? It did a little bit more than that, but we have this range, we have this range, and we have this range. So I don't know if you noticed, but things seem to be happening in patterns of 3. And the safest range for the next term tends to be in the bottom third of the previous one. So let's say that we've hit our bottom here. And I'm thinking, okay, well, I want to come up, but I don't know if this is actually the bottom, so I'm going to let it test. And then I come around somewhere in here. I want to have my trade be narrow enough to where, before I know what this peak is going to be, that most likely I'm going to be in the bottom third of it. So I would need to get in low enough to get up and out. And then anything extra is icing on the cake, or you've played it safe and it doesn't matter. You got, mission accomplished. You got what you're looking for. So that's how, as it applies to the moves that you're making in the market. So obviously you can say, okay, well, there's that 2, 3, 4, 5, 6. Yes, I understand. It's not always a perfect, third for third. You are looking into something. But we're also looking at a really generalized example by zooming out. The next thing in the principle of thirds, just giving you an overview, is that what happens over a long period of time tends to repeat itself in shorter periods of time. So it gets a little bit difficult to map as you, if you're wanting to look at something that happened a long time ago and you want to actually see it as it relates to the rest of the chart. I haven't found anybody that's really developed a really good scrolling system that is just as accurate and just as detailed, but really easy to just slide through. And yes, you can slide, but you really need to be able to just zoom, just swipe along and get there. So boom, 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 and then there's a change in a pattern. So what I've noticed is that if something isn't going 1, 2, 3, and then it changes, very often that change in the pattern is the thing to watch out for. It's either, going to really change things up Or if it continues, there's kind of a fake out. You're saying like, oh, well, there was 4 this time. Believe it or not, that 4th is usually where something bad happens. And so sometimes there's, nothing you can do. Not to take a loss. But so, I mean, you can see right here, I mean, this is very different from what we see in this pattern. This was a little bit different. I agree. Boom, boom, boom. If you look at it from the base up, we're establishing the next one right there. So it's just, if you are visual especially, I mean, you're like, okay, yeah, I get it. But we're now, as we move along here, this represents 4 hours, okay? Well, if I come down to here, then I should have 3 of what that actually represented. So as I'm kind of zooming into shorter and shorter time, we're going to find that the pattern repeats itself over a long period of time, over a short period of time, in our minute to minute, and over the lifetime of the coin. And most people haven't mapped out, we're going to pump exactly this much every single day, all the time, everywhere, and it's going to come out to this. Nobody is planning things that far ahead on their pumps. So this is something that reoccurs because it reoccurs, not because it is so intentionally mapped out, that everything has been thought out. So as we get further in, we're actually getting more details about what's happening in between that time. You might have one candle that represents all of this, but if you look, we basically have peak, peak, peak. So another thing that you will notice, and let's see, I'm trying to think of the easiest way to visualize. I'm just going to go ahead and put up everything that I would normally have. And you might see that, when you have these areas where things open up, they tend to define a pattern or a length of time or a period of time. And what you'll find is in your principle of thirds, if you're looking at groupings and trying to decide where to get in, usually at, the bottom is a safe place kind of situation, your first spike is going to be the biggest. And then the second one looks the same but smaller. And by the third one, you start to lose the pattern. If we zoom in here, you're going to see something that looks exactly like this, but smaller. But as you start to lose that pattern, this time there's still somewhat of a spike to it. In fact, let me see if I can get to 227.18 with slightly more information. 227.18. We're looking at exactly the same thing we were looking at before. Right in here, okay? So now you can see biggest spike, and there's a bit of a swoop, bit of a swoop, bit of a swoop, and then it comes down, and we have this kind of new, it's a different angle. It's not jump, 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 jump. It's longer and more at a slant. When this changed from the previous pattern, which is kind of going up in a grouping of thirds, boom, 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 this time it's at a different angle. It's a weird kind of slant. And then it takes this curvature. Now, if this were the other way around, if this curvature was here, it would be a sign of it weakening. In this case, it's going into a new grouping, which kind of would have been a signal to buy in around here. Okay. With it being Raven, I'm a little bit skittish because I've been waiting for it to go up for so long. I don't want to read a false bull run into it. Is probably coming back down now. So what's tricky about the principle of thirds is that it's doing that against whatever Bitcoin is doing at the same time. So it's going to change the natural flow of people's response. So, people look at the first thing that happens and say, oh, wow, I want to get on that, but I'm kind of scared it's not going to do it again. And so the next time is almost inevitably slightly smaller. And then, if people see the evidence, the first time I did this, the second time it's smaller, I better wait longer to get in. Well, I don't want to wait too long. I'm going to go ahead and try to get a little bit out of it. And then they sell off quicker because they're even more scared that it's going to get stuck. And so the whole thing is a self-fulfilling prophecy. So if we look at even this line up, you can see that it didn't just go boom. That it went, yeah, and then it changed. And now we have the first new pattern. Over here, wouldn't read too much into it, that short in the process. But so we have a new pattern developing. And then it comes down here. And so now it's establishing a new pattern up here. Yep, yep, yep. and then we have that curve again. Yep, yep, yep. And now we have that curve. Now it's weakening. Remember I talked to you if it wasn't this, but it was this, we have a weakening. So sure enough, as we lost that spike, this part was almost inevitable. Now it could have traded sideways, but it's kind of doing its own thing. So what happened next? Boom, boom, boom. And then there was a change. Boom, boom, boom. All right. I mean, do you see that this is, we're not even talking about trend lines and, delayed measurements, things averaging over time. We're just literally just looking at the pattern. And this is a very advanced study that I think that, looking at it from a principle of thirds makes it pretty darn simple. So that's just looking at it with one coin. If I took, a day to go through this just for the basic introduction, I would be able to find, some just really glaringly obvious examples. And I was looking at Bitcoin thinking that surely the one with the most volume and the most movement would be the easiest to see it in. And I'm just not sure if that's actually the case. But, well, okay. At this pace it is. Boom, 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 boom. And then you can see bigger, medium, small. And I mean, this is just, it is so much of it is human nature. Yes, there is a lot of manipulation going on. This one, I actually wouldn't have expected that, but once it did go down, boom, boom, boom. So, like I said, it's not every single thing every single time. But I mean, that's over the lifetime of the coin. Now let's zoom in to somewhere here, very steady movement over here. Let's see if we can see it zoomed way in. Okay, so you can see your arches as they're going along, your spikes. Even when it's kind of having a hard time, you can see, Okay, so our spikes did diminish and our downward movement increased. So even the downward movement seems to be happening in groupings of thirds. Boom, boom, boom. Yep, 1, 2, 3. And then it changes. And it kind of did like a double hop because something huge was coming. And this is very likely somebody selling before they got to a certain buy-in point. And then 1, 2, 3. And then a change. Was there a change there? Yes, there was. There's that, slight weakening. Didn't have enough here because why? Something else big was coming. And it's just over and over again. 1, 2, 3. All right, so that is the basics of the principle of thirds. It covers so many more things because within those different trades, you're trying to choose your position based on the bottom third where things are safer. But then how do you test the bottom if it might still be going down? So we're going to look at earlier data and just look under an absolute microscopic level of information. And even then, it's so easy to overlook something and then get stuck in a position. So, we're going to look at other things to add to the rule of fifths, meaning how much money we got, and the principle of thirds, meaning, have we chosen the right position? And then we're going to compare that to averaging. We're going to mentally be able to think in terms of where we are on the exponential growth curve. All these things come together. Boom, you plant your position and it does what it's supposed to do. Mark it off the list. You're on to the next one. And that's basically how it goes. So now you know the basics of the rule of fifths and the principle of thirds. You can put them together with the exponential growth that we learned in the lesson plans. And whether you're in the free version of it or the more advanced version of it, you have, a wealth of information to put together. All of the different variables that you can learn from and establish a really good plan for growing your wealth. I hope you found this interesting, and please let other people know about us. We're going to move on to the next lesson. And thanks so much. It's exciting to be teaching this to you, and I hope that you're finding it exciting to learn. So please feel free to ask questions and, be a part of the community. We're really excited about being on this journey together. So be good until next time. Archangel Alts out.